Welcome to the State of the Markets podcast. I'm Paul Rodriguez of ThinkTrading.com.
I'm Tim Price of PriceValuePartners.com.
Alexander Ineichen, welcome to the show.
Hello, thank you very much for having me.
It's absolutely fantastic to have you on the show. We're really excited to hear from you. Could you just give us a little breakdown of your history in the financial markets and what you're doing at the moment?
Okay, I started in the financial industry in the late 1980s. My entire career I was in research, so I'm a financial analyst. In the 1990s, I did research on derivatives, first from Switzerland and then out of London. I spent a lot of years many years in London.
Was that with UBS, Alexander?
That was First Bank, Swiss Bank Corporation, which then eventually merged into UBS. Yes. Yeah. And then in the 2000s, I did research on the hedge fund industry. So in the 1990s, I sort of like catered towards. I did research for the hedge fund industry, and then in sort of like around the year 2000, I put out a publication called In Search of Alpha. And then I did research on the hedge fund industry for roughly a decade. So that's the 2000s. And then in 2009, I started my own company, which I still have and run. It's a one-man company. And first, I continued to do my research on the hedge fund industry. And then sort of like in the 2010s, I think around 2011, I started the research, which I do now, and I call that risk management and nowcasting research. So the risk management is consistent with what I did in the 1990s and 2000s. And the nowcasting is sort of like an age thing. I gave up. I'm 58 years old, and at one stage I gave up trying to predict the future. So I'm not a forecaster. I do nowcasting, which means I identify trends, right? And that's what I do. So it's a mix. What I do now is institutional research. I mean, I have a couple of private clients, but it's mainly institutional. And the idea is not to predict futures, but risk management and nowcasting research is what I do now.
And you've also written a number of books, haven't you? I've got two of them. I've read two of them: Absolute Returns and Asymmetric Returns.
Yes, these books came out of my research, which I did for UBS. So the Absolute Returns one is sort of like making the case for absolute returns. And what I meant with that is like a bit of a contrast to the traditional way of benchmarking. So it's relative returns versus absolute returns. Even if you could argue, you can make the argument that for example, hedge funds are relative returns as well. For example, they try to beat cash, or they are also driven by at least partially by what the competition is doing. So there's a certain pressure that you cannot be a negative outlier. So the term absolute returns needs to be taken with a pinch of salt. And then the asymmetric return theme, that's sort of like the derivatives background with options allowed for asymmetric risk exposures, which means you want a lot of the upside and you want to sort of like manage the downside. That's the idea of the asymmetric returns book. And then the third book.
Please go on.
Yeah, the third book I put out in 2001 is called Applied Wisdom. And that's more like a fun book. It's sort of like related to finance, but I started writing. I started enjoying writing actually very early on in my career. And the reason for that, I was a trainee in the late 1980s, and I was at the options desk, and no one wanted to write market commentaries for the local financial newspaper, and so it landed on my desk, and I enjoyed it. Right, so that's how I sort of like became into enjoying writing, and I started using a lot of quotes in my written in the research reports. And the feedback was very good for the quotes. So in 2001, instead of writing something about finance or risk management and then using quotes, I turned the thing around. So I started with a quote, let's say, from Winston Churchill or whatever. And then I sort of like applied it to the wisdom in the quote. I then applied to a financial narrative.
You mentioned earlier the absolute return concept. There's a book I'm sure you'll be familiar, Against the Gods by Peter Bernstein.
Yeah.
And I came across this in the late 90s, whenever it was first published, and it something leapt out at me, which was it was a quote from Daniel Bernoulli, which is along the lines of, if you're managing money for wealthy people, the practical utility of any gain in portfolio value inversely relates to the size of the portfolio. Or in plainer English, if you're managing money for wealthy people, just don't lose it, because they've already got the wealth to begin with.
Yeah.
So that set me on the course of the merit of absolute return investing. And for the life of me, I can't see why anybody has any benchmark other than absolute return one.
Yeah. That's actually, it's interesting you mention that particular book, because that was also very influential for me in the 1990s, because it was sort of like the history of risk. And I was a Peter Bernstein fan, and out of the blue, I asked him for a quote for the back page of my book, Absolute Returns, and he responded, and he was like in his 80s already then, and he responded within very, very short time and said that's exactly what he's thinking, and that's sort of like the year 2001, right? And he actually did a blurb, like a quote, after he requested a draft of the first chapter and the last chapter, and based on that he gave me a quote, which then I used on the back page of the book. Yeah.
Have you read it, Paul, Against the Gods?
I haven't, no. Maybe you could explain a bit about what's in that book that made it so compelling for you, Tim, because you have mentioned it a couple of times.
Well, if Alexander's familiar with it, I'll let him explain. Because
sure.
I'd say it's a history of risk, and it's also a biography of how risk has sort of changed through the ages.
Yeah, I think Peter Bernstein, he was also editor. I mean, he was in the Second World War. He was a fighter pilot, right? And then he became a consultant, and then he went into finance. And I think starting in the 1970s, he was for a very long time he was the editor of an academic journal called, I think it was called the Journal of Portfolio Management. So he had a bit of an academic bias. So when you read Against the Gods, it's his heroes are the academics. So he starts very early on, going thousands of years back, and then it's really a history book. It's the history for me. It's a history book, the history of risk, and then he goes into more modern applications. So he goes through the academics who receive Nobel prizes like Bill Sharp and of the Sharp ratio, and that's sort of like his world. But it's still a very good book if you are a bit interested in history, or you are a CFA. It might not be like super practical. Like it's not a do-it-yourself, or like it's not a to-do book. So it's
like a how-to.
Yeah, but it's definitely. I think I've got a ranking. Because I'm often asked after conferences and by clients, what are my top 10 or top 20 books? And that's very high up there, Against the Gods, because it's the history of risk, and there's a lot of math in risk, and so he goes through a lot of the history of math, how the probability analysis and all that. But without being technical, so it's not, you don't need a math degree to understand that particular book.
So how did your book develop, or books develop from that one? How do they differ?
Well, the Absolute Return book is much more related to hedge funds, and it's not a history of risk. So it's not, the time span is not. I don't start, 2,000 years ago. I start in 1949, which was the the first, let's say, hedge fund. Although actually I go a bit further back, because there's also Benjamin Graham, who you could argue had an absolute return approach, because that benchmarks came later. And so it goes a bit further back than 1949, but it's the history. It's partially the history of hedge funds, but also it also goes through the various strategies, explaining some arbitrage strategies, how they work, and so on.
Why do you think, I mean, I have my own answer, but I'll let you answer first. Why do you think the industry continues to focus so much on index relative benchmarks?
Well, it's convenient, and also the bulk of academic research suggests you shouldn't be an active investor, right? There's so much research suggesting that you should be very close to an index, and that over time you cannot beat an index.
Even though the careers of Benjamin Graham and Warren Buffett would tend to suggest that idea itself doesn't work.
Yeah, no. I mean, Warren Buffett, whom I quote a lot in all my work, he has been making fun of the academic research, I think, his entire life.
I mean, I think probably the most pertinent quote is, "If markets were efficient, I'd be a bum on the street corner with a tin cup."
Absolutely, but statistically he's an extraordinary outlier. I mean, he compounded capital over his career at 20%. I mean, that's
almost impossible.
Well, it's. I mean, you might find a hedge fund manager here and there who over a shorter span had a higher compounding rate, but 20% over such a long period, that's extraordinary. So he's not actually relevant for all the pension funds and insurance companies who manage money. Large funds, and also might have different objectives. So, for example, an insurance company matching assets with liabilities, which is also a relative return approach, actually makes sense for them because they have a different definition of risk. Not that they don't have the same definition like you and me, as in our definition as a private person. You have obviously survival being the main criteria, which is an absolute return yardstick.
I mean, Buffett's not an outlier to the extent that I think he wrote the essay, but there's an essay, The Super Investors of Graham and Doddsville, where he points out there's a track record of extreme outlier or seeming outlier performance by a number of managers. And what they all had in common was they all basically picked up value investing from people like Ben Graham, and David Dodd.
Yeah, but with the thing with outliers is that there are only books about the positive outliers. You also have all the negative outliers. Some of them are still in prison, right?
The Madoff outliers.
Yes, exactly. And there are many fewer books about the negative outliers. So as an institutional investor, you have sort of like this responsibility versus your agents. Or actually, versus the principal, you're the agent, and versus the principals, the people who own the money, and that's why it's conservative is defined as being broadly diversified and benchmarked, and there's a lot of bureaucracy. There's many layers of compliance, and all that is to some extent actually makes sense. So you do not have sort of like in institutional management, you shouldn't have these gunslingers who have at times perhaps very concentrated portfolios, which works in the hedge fund industry. That's fine, and it even makes sense for institutional investors to invest in these gunslingers in the let's say in concentrated portfolios, and the way they manage risk is with position sizing, right? So the exposure to a single company is quite small. Let's say in a large pension fund, and the same logic should also apply with a single manager, right? So there is a link between being benchmarked and investing in hedge funds.
But to go back to my earlier question, my answer to why the industry uses index relative is simply because that allows the industry to grow to an abnormal size, because it basically allows a load of people who are doing the same thing to prosper, and nobody's sort of head is above the parapet because they're all doing broadly the same thing. But I'd argue it's not in the best interest of the individual client necessarily, whether that client is institutional or private.
Well, I think the one reason for benchmarking and indexing is cost. And I think that's an extraordinary powerful argument, that an institutional investor. I mean, I've done thousands of meetings, and some of those meetings were in front of committees, which were. I mean, I had people falling asleep in meetings, and they are responsible for
billions of dollars.
Yeah, and they focusing for them. For these committees, focusing on cost is not, I don't think that's a bad idea. It's just not for everyone, but sort of like these large institutions where you have the decision making is nearly always committee based, and focusing on cost is not such a bad idea. You cannot have, you cannot have sort of like the entrepreneurial outlier Warren Buffett type in one of these committees. That just doesn't. I don't think that's a good idea. There might be actually exceptions to that, like former hedge fund managers taking over a large sovereign wealth fund, for example, in Norway. That might work. So there are exceptions to that, but by and large, the institutional approach of being benchmarked and really caring about cost is a positive aspect, I think.
Given that everybody's comparing their performance against other people or other funds, and other funds compare themselves to other funds, what would you say is a good way to, or a reasonable way to then measure your performance?
Well, I think that as an investor in hedge funds, the performance is always backward looking. And that's an issue, and you have to sort of like there's an element of cynicism that you invest with those who did well over the past 3 years, and then there's mean reversion. So I think that a good way is an investor being comfortable with the investment process of any active manager. So it needs to make sense, and then obviously the due diligence you want to deal with people with integrity, right? And there's certain things need to be in place with the hedge funds, and one aspect is the ownership capitalism argument of Warren Buffett. You expect these active managers to have skin in the game, and that is one of the big differences between sort of like the institutional landscape, where I've had a ton of on the topic of ESG, which was a topic over the past couple of years I wrote about. And there I had of clients, institutional clients. Officially, they're pro ESG, and then with their private money, they invest in ExxonMobil.
Yeah, right. I can believe that.
So that's that. But I'm not sure you want to talk about ESG with me.
Not really, but I mean, happy to if you really wanted to. But
no, I'm done with ESG. So.
Yeah, absolutely.
I think the average investor's done with ESG as well.
I think so. Yeah.
Well, the kind of nub of the question that I was trying to get to really is it's really fascinating to hear the argument that Tim puts forward with. You shouldn't really benchmark your performance to what the FTSE or the S&P or the Dow is doing. You shouldn't benchmark. But then if I was setting a fund up and I wanted to decide how my performance is, I guess a lot of that would depend on the expectations of the investors. But what would be a reasonable mark to say, a benchmark for how that performance is working? I mean, do you look at for example, if it's cross asset, you can't necessarily benchmark it to the S&P or the bond yield. Do you have to find similar funds within that realm to then say, oh, I'm doing better or worse than X? Or does one take the idea that value investing is the ultimate protection of funds, and therefore should we all be benchmarking to a value investing fund?
No, I think different investors have different objectives, and one of my arguments I made, sort of like in the 2000s, was that one needs to distinguish between strategic asset allocation and tactical asset allocation. Now, with the tactical asset allocation, if you have an equity portion, benchmark, let's say you're a pension fund or an insurance companies, you give active mandates or passive mandates, then having a benchmark, I think that is fine, and it's good practice. But then what I also claimed is that every investor is an active investor on a strategy level, because the strategic asset allocation of any institutional investor is people like a committee, people with responsibility sitting together and then coming up with something, and then they stick to that for until they screw up essentially. But it lasts. A strategic asset allocation can last very long. So the most famous one is 60-40, 60 in equities and 40% in bonds, right? And the criticism is that what I did 20 years ago, I said, hey, look, let's have a different strategic asset allocation. Let's do equal weight. 25% in equities, 25% in bonds, 25% in gold, and 25% in hedge funds, right? And that's actually better diversified, and it has the higher return. So if you think in Sharpe ratios, the institutional investor actively picks their strategic allocation, and then they rebalance regularly, typically quarterly, or sometimes it's semi-annually. But that's an active call, and there's a lot of room for improvement. Now with insurance companies, they have their asset liability matching, and that's very important. That's what drives large parts of the risk. But with pension funds, you could argue there are better ways than the typical 60-40. For example, gold is I have a client who has for institutional an insurance company. They have 6% in gold. And that's very high by institutional standards, right? So the typical allocation is much closer to zero, and the same is true for commodities. So if you want to criticize the institutional landscape, is that there's a lot of dogma about the strategic allocation, and that could be loosened up a bit by considering other forms of investment.
By the time those performances in gold and commodities are looking good, that's when the committees then decide to move into those areas, and invariably those are the times when you're near the end of the trend.
Yeah, that could be true. I mean, it's not. I mean, a couple of decades ago, equities, for example, were, I think in the 60s, they weren't part of a strategic asset allocation at all, and then equities did well, and then they entered at one stage. They did enter the institutional mix. So yes, it's a cynical remark, but there's a lot of truth to that.
So you mentioned commodities, which sort of brings us up to speed in terms of what's happening in the world. What's your view from 30,000 feet as to what's going on now? Because I suspect we'd get into a bit of a sort of macro palooza of a sort of a discussion. What's your assessment of the world and from sort of major asset allocation calls at the moment?
Macro palooza, Tim. That's a new word I've never heard. Is that your word?
Yeah, but it's I'm sure it's via Buffett and Munger. So
oh, right, okay.
I mean, I'm surprised that the markets are holding up so well. I mean, I've got a chart of the S&P in front of me, and the correction is less than 10%. and the index fell to a level where it was in autumn of last year. So that's like,
given that we're currently in the middle of World War III.
Well, I do not subscribe to the World War III narrative, but yes, I mean oil price is above 100. And that's actually not that high if you adjust it for inflation and the spikes in real terms in the 70s were much more extreme, right? And the inflation was more extreme in the 1970s, and the drawdowns in equities were much more extreme. So far, it's sort of like a bit. I compared in my research. I compared 2026 with 2022. Now, the start of the war in 22 was in the same calendar week as in 2026, right? Like this year, sort of like towards the end of February, early March. That in that ballpark, and it was a surprise, but it wasn't sort of like It's not a 5 standard deviation surprise. It's more like a 3 standard deviation surprise. I find so it's much less disruptive than, for example, in April 2025, the tariff, the tantrum Donald Trump had with the tariffs. The drawdown in equities was much more severe, and then there was a correction on the upside. But I'm a bit surprised that markets are holding up well, and that's actually a good sign. But to answer your question about how I see the world, I do nowcasting, as mentioned, and what I look at, what I really try to measure quite accurately as I can, is the changes of the various consensus estimates on a macro level. That's the various countries, and on an equity level, that's earnings expectations, and then I have scores, and from end of 2022, certainly 2023, the whole macro setup was actually quite good. With this short interruption in April of last year. But what happened in 2022 was what I then called the energy regime, and everything is sort of like related to energy is doing well. So, for example, Brazil is a whole stock market which is driven. It's one company, Petrobras, which has a large influence on the whole market. And then in the UK indices, you also have energy. And in the S&P, energy has a much smaller weight. So I think there is a comparison there between 22 and 2026. So that's sort of like my narrative at the moment.
One of the similarities I'd say between 22 and 26 is that on a geopolitical level, the fact that the West basically chose to levy sanctions on Russia was sort of like the first nail in the coffin of the petrodollar, to the extent that it triggered a huge rush of money out of US Treasury bonds and into gold. And you get the sense that trend will continue. And then this more recent invasion of Iran by US and Israeli forces, or air forces at least, suggests that the acceleration out of the trustworthiness of the dollar is going to continue now, because as someone sort of rather farcically put it a while back, there's only one thing that's worse than being an enemy of the US, and that's being an ally of the US.
Yeah, well, that's also quite a cynical thing to say, which I wouldn't.
We're normally quite long cynicism on the pod here. So.
Yeah, that's fine. That's fine with me. I think there's always a big element of truth behind cynicism. But I mean, I do get the argument. I think Donald Trump has done a lot of damage to the reputation and relationships of his allies. I mean, what he did with Canada is absolutely ridiculous. And so there are negatives, and I think it's a consensus that his presidency will be one of a weak dollar. Although in the recent couple of weeks it actually spiked a bit. But I think the general trend is for a weaker dollar, and the Americans will need to pay more for funding whatever it is they need all this debt for. But still, if you then go on and what are the options let's say for Europe? Do they want to lean towards China if they and break relationships with the US? And I don't think so. I mean, it's the US is still the allied forces, and I think the English speakers this let's say the Western Judeo-Christian civilization is still where we're heading, and even if Donald Trump is a bit of a disruption, a bit primitive at times, but I think if you compare the U.S. Under Trump with the options, then I think the world won't sort of like migrate away from Pax Americana.
To what extent are you bothered by the seemingly uncontrollable rise of government debt? I mean, specifically the US, but not by no means limited to the US. Because my own concern is that it's going to accelerate this loss of confidence in the dollar, because these debt piles are now so huge. I think realistically, it's very unlikely they'll ever be repaid in anything except devalued money.
Well, I think the probability of the U.S. economically growing out of its debt is larger than in Europe, right? And I also in the 1990s, I remember these discussions about Japan being toast because of its debt, and Japan is still around, right? And with debt of I don't know 230 or 240% of GDP, and it's still alive and kicking, and the living standards are good. So that's why I do not forecast like an Armageddon scenario because of rising debt levels. So that's not what I do. It's and I also with respect to debt, I mean, one of the stories I've been writing about also on Substack is this ESG climate change story, and which is a story of the misallocation of capital, right? So if you misallocate capital, that's bad. So if you go into debt and then go on and misallocate capital into I don't know, consumption or something which is useless, like windmills, for example, that's a big negative. Whereas if you go into debt and you invest in future generations in infrastructure which makes sense, like for example nuclear energy, then that's fine, or that's much less bad than if you squander, if you waste all these investments. And I think Europe is in a bigger problem. I think this net zero is absolutely crazy. It's a misallocation of capital, and it'll be harmful for future generations. Whereas the US,
why do you think? Sorry to interrupt. Why do you think the net zero thing is even being tolerated by the people of Europe? Because surely the average man in the street knows exactly how ridiculous these policies are. Here in the UK, we're sitting aside huge resources in the North Sea that we can't get access to because our government's building windmills and solar farms.
Yeah, well, I think
are you surprised it's lasted this long? Because the backlash is growing here in the UK, it seems.
Yeah,
if not elsewhere.
But there's this crude remark, like a quote, right? I don't know who said it, but in a democracy you get what you deserve, right? So and I think Germany is in an extremer case than in the UK. The UK still has nuclear energy, and so speaking from the perspective of Switzerland, there's still hope for the UK.
Well, I was going to ask, what's the Swiss energy profile? Where do you guys get your energy from?
It's about 40% is hydro, which is dams, because we have the Alps, right? That's very, very convenient. Then about 30% is nuclear. And the Swiss population were also a bit negative on nuclear for a couple of decades, which means no new plants have been built or planned. But that is changing. So I think that the population is becoming a bit more positive. But the Swiss and also the French, because they have nuclear and the Swiss have nuclear and hydro, both of these are very clean, right? And our northern neighbor, who are all net zero fanatics, the Germans, right? They have a lot of windmills, which means they have a lot of gas and coal because they have no nuclear, right? So their pollution is beyond that of France and Switzerland big time. So which is quite funny because they talk. If you listen to I listened to some of the speeches in the Bundestag. They spend all day talking about climate change and net zero, and then they go on and pollute the planet big time with their energy mix. So and in the UK I think it's less. I mean, you have what's the guy called in the UK who plays
Miliband.
Yeah, who plays banjo in front of the windmills. That's ridiculous as well. So the UK has a ridiculous energy policy as well. And one wake up call I think was in 2022 because before Putin attacked the Ukraine, energy security wasn't a topic, but since then it is a topic. So people are reminded that energy security. So you need a diversified mix.
Sure.
You can't rely on gas entirely, like the Germans did from Russia, and so on. So if you're an optimist, then you see there are some positive aspects of reality kicking in, and if reality kicks in, net zero goes out of the door. Like ESG. ESG peaked around 2022. It was very big in finance, and then the disruption of the Ukraine war sort of like put the first dent, and the reason is energy security, I think. And now I think ESG has been in decline ever since, judging by flows going into that nonsense.
What do you make of AI?
Well, I think it's the next. I mean, in my third book, I make fun of forecasters, and one way to gain an audience is by fear mongering. The reason why that works so well is because the fear sits with a different part of the brain other than the neocortex. It's sort of like the emotions generally are directed more by a more primitive part of the brain. The neocortex is quite new from an evolutionary point of view, and that's why it works. Religions have been fear mongering for thousands of years. That's how they control their flock. And people like Al Gore, they know that. So that's why this whole climate change movement, it's targeted at fear levels. Now in finance, you also have the perma bears. They know that as well, right? You just gain a huge audience if you have something really negative to say, like a negative narrative, because people respond emotionally. And now AI is the next thing. If you want an audience, you say things like, AI will replace 80% of white collar jobs, and then you go with that we go with that narrative. For me, AI is a tool. I use it instead of Google. I mean, I use it, but I don't think see the end of the world, or I think there's a huge hype. And what I'm, as an investor, what I'm wondering whether that's the next big misallocation of capital, because I think ESG is more or less done. I think the net zero, that's a misallocation of capital. I think the peak is in the past, but now there's hundreds of billions of dollars in going into that infrastructure which is behind AI. If you look at the Mag 7 stocks, which sort of like, or technology stocks or US technology stocks, they're off their peak, but that it's not yet a complete collapse. I think in the year 2000, the Nasdaq corrected 80%, and if AI turns into a misallocation of capital, then you would have a large drawdown in the Nasdaq and related equities. But we haven't seen that yet. So I'm still open as to whether it's a net positive for shareholders and something which will allow companies and economies to grow for the next 5 or 10 years. So I'm still open. I understand the bear case as well as the bull case, but I haven't chosen on which side I'm on, to be honest.
It's not as though it's a new idea to be predicting that it will be world changing, and the fact that it's priced where it is at the time of a major bull market seems like, well, what more can you squeeze out of this? And if we look at history and how, for example, the .com boom came about, and then you got the boom and then you got the bust, but then it shakes out into the real technologies that are going to change the world. It does take a long time, but in that first phase, which is clearly where we are now, the market does overestimate what it's going to do, and then investors get overexcited, as they do, and start buying a narrative without really looking at the numbers, and then things turn down because it's all been priced in, and they get disappointed. So it's a fairly common. It's a kind of usual market narrative, but the technology itself is world changing, groundbreaking, whatever we might say. We are already seeing the effects of it, and there are some industries that will definitely be. I mean, we could predict fairly confidently that there are certain industries that are going to disappear to AI technology. I think that's fair enough. Would you agree?
Yeah, I think I've got two comments to that. First, I like the comparison with the railroad. It's not my comparison, but it's something I picked up. AI compared to the railroads in the 19th century. The infrastructure, the buildup of the infrastructure was groundbreaking. It changed everything. It changed mobility big time. It was huge, but it didn't end well. It didn't end well for the investors, right? Because there was hype, right? So you have this boom bust cycle, and my suspicion is that we had that with the internet, right? And I think my suspicion is we will have that with AI as well. And to the second point, I think for me it's a tool, and if it changes the productivity, which I suspect it does, then that's a good thing. But given that it's a hype, I think the expectations might skyrocket or perhaps have already skyrocketed, which again suggests that there will be some sort of like boom and bust cycle. I just don't exactly know where we stand on that cycle. Is that the latest 2 months? Is that just a minor blip? I mean, if you look at the stock of what's it called?
NVIDIA?
Huh?
NVIDIA?
No, not NVIDIA. A smaller one. The owners of ChatGPT. What's the name?
OpenAI.
Yeah, I think that was what's the ticker? I think that has a much larger drawdown. I would need to look up the exact numbers, but that would suggest the whole thing is already over, and it takes a while until the market changes the valuations of these companies accordingly. Although if you look at the what's the Taiwan company?
TMSC.
TMSC. And also Samsung, they have done extraordinarily well in the recent past, also driven indirectly by AI.
It's funny you mentioned the internet and railroads. There's a lovely quote which I'm sure you'll have heard, which is the pioneers get the arrows, the settlers get the land.
Yeah. It's also the idea with the in a gold rush. I think the sort of like the Warren Buffett logic is that you want to be
picks and shovels.
Exactly. And that would be Nvidia, right? And some of these companies who cater to the industry. And within energy, you also have nuclear energy. There's I think there's at least been already one sort of like brief bull market in nuclear energy stocks based on all the power which is required, and nuclear energy is so much more intelligent than windmills. That if you're an optimist, you could argue that the buildup of energy capacity, energy security is good, independent from AI. So the motivation might be that the companies are building that infrastructure, and if in 5 or 10 years we end up using that infrastructure for something else, that's sort of like not a negative.
You mentioned that you're a nowcaster and you're not a forecaster.
Yeah.
But aren't we? How can you? Even if you're looking at the kind of near term, you are still forecasting, because otherwise you're just reporting the news.
What I have, I've got this scoring system where I give it's the idea I got from a guy called Piotrowski. So in finance, there's the Piotrowski score, and it's a score from 0 to 9. And it's based on fundamental variables, like from the balance sheet, from the cash flow statements, and from the income statement, right? And the problem with that score, it doesn't work for equity investors, right? So I took the idea and I replaced the factors with momentum factors. So just that's sort of like different factors of momentum.
Such as?
So like 3 months returns being positive gives a point. 6 months being positive gives a point. And then I have momentum indicators like moving averages. Like I've got something which I call medium term momentum and long term momentum. So that's already 4 points. Then I give another 5 points for if the earnings revisions of the analyst community is positive over 1, 2, 3, 6, and 12 months. That's another 4 points actually. So we're at 8. And then one additional point I give for earnings momentum. That's also like a long term like a long term change of earnings expectations. So Nvidia has been a 9 on that score, and all these beneficiaries have been a 9 on that score, or an 8 for a very long time. And for me, that's not forecasting. So I have absolutely no idea when the thing will decline. A good example is Novo Nordisk. That was also a 9 for a very long time on my score, and then suddenly within a month or two, it was a 0. Right. So it measures objectively the change, and there's no forecasting on my part. But what I do admit is that there's still an element of forecasting in that, because I pay attention to the change of the earnings estimates, and the earnings estimates, these are the forecasts by the analysts. So when they go into the office in the morning and revise their earnings upwards, then I pick that up and I give points. But then if they come into the office and reduce their earnings, then it's a 0, right? And if you look at the chart of Novo Nordisk, it's a very classical boom and bust cycle, right? The boom was straight up and then straight down. And these are the things I can measure. where the flaw of my approach is when it's sort of like sideway movements, right? Either in a tight or in a volatile band. That gives me headaches. And also my nowcasting approach is exposed to gap risk. So like say if the Vogons attack Earth tomorrow, that's not in my scores, right? That's sort of like a disruption.
But what you're saying there though is that you can't forecast unforecastable events. That's which is fair enough.
Yeah. Yes, but I can measure trends on the way up and on the way down.
Oh yeah, absolutely. I just meant with regard to, if something happens tomorrow that disrupts the market, you can't, 9/11 type thing. Although when these things are planned, there is a build up in the charts that you see, but ultimately a truly random event you can't factor into any model because it's just impossible.
Exactly. That's perhaps one of the reasons why I've given up on trying to forecast events, because you can have, even if you are a reasonable forecaster, behind every forecast there's a conviction, and that conviction is never certainty. So you might believe in your forecast, but you still need to take into account that, let's say, gap risk, something unexpected to happen.
The scoring system that you mentioned, Alexander, is that designed for institutional clients, or is it also appropriate for private clients?
I do have great feedback from private clients as well. But it's it takes some time to it's like the private clients on my mailing list are either former professionals or it's people who want to spend some time thinking about their investments. Let's put it that way.
And that's a paid subscription service, is it?
Yes, that's paid, yeah, and it's institutionally priced. But I also write on Substack, so I've got a newsletter on Substack. It has a bit delay, and it's sort of like the slides are from my research packet, and that is a lot of it is for free. So if you subscribe to that, and then some of it is behind a paywall, but completely different price than the institutional stuff.
Do you rate, obviously as a contributor, but do you also rate Substack as a user? Because I find it a fantastic resource.
Yes, I moved from, I think a couple of years ago, I wrote articles for LinkedIn, but I think I might got cancelled there or something, because suddenly people said they haven't heard anything from me.
Or the algorithm changed somehow.
Yeah, but I think because I was very critical on ESG, and sort of like suspect they didn't like that. Whereas I'm quite happy with Substack. I must say it's easy to use. You can put something behind a paywall if you want, and I enjoy writing. So it's, for me, Substack is great.
The guy behind it said that it's possible to leave Substack, but we want to make it so that you just don't want to, and I think they've done a really good job. I wanted to ask about your model and how you rate it from 1 to 9, which I find intriguing, because intuitively, when you hit a saturation point where everything's hitting 9, would there be a area where you could increase that kind of? So I'm laughing because I'm thinking about the turning up to 11 from Spinal Tap, but I'm thinking more of having more of a gradiated level near the top.
Yeah, that's a very, very good practical point. And for that, my answer to that, the practical answer is the score it gives 9 points, and in a bull market, I make actually fun of my own research because everything's a 9, right? or nearly everything is a 9. But then the next level is change of change. So the score is I measure the change objectively. But the next level is change of change. So if everything is a 9, then for my rankings, I measure the magnitude, the strength of the changes. So I measure the standard deviation of price change. I measure the standard deviation of the earnings changes. So it could be that 2 sectors are a 9, but in one of the 2 sectors, the earnings are revised upwards like a 2.5 standard deviation, whereas in another sector it might only be 1 standard deviation. So that allows me to rank. Even if everything is a 9, I still have a ranking, because I focus then for the ranking on the change of change, not just the change. Do you understand what I mean?
Yeah, definitely. Yeah, absolutely. It seems like you obviously clearly thought of it already. And with regard to the universe of markets that you look at, do you differentiate between the US, UK, and then do you go sector by sector as well? How are you breaking it down?
I've got both. So I've got by country, I've got 24. So like the main markets, and world is one, and also Eurozone, and then I have 22 countries. But then I also look at some smaller countries, but not as accurately. And then what I think is even more valuable is the breakdown by sectors, and there I use the the global standard index breakdown of 11 sectors. And then on top of that, I separate 3 industries which behave a little bit differently, which is mining, banks, and defense, right? So I have the 11 sectors plus those 3. And actually, it's actually 4, because biotech I also treat separately. So that's the country breakdown and the sector breakdown. But then I also have a breakdown by themes. So I've got one page where I look at themes. So for example, the nuclear energy theme. So they're ETF. I measure the ETFs, and then behind the ETF there's a benchmark, and potentially the quality of the earnings data from Bloomberg is good enough for me to calculate my scores, right? And then there's cybersecurity is another theme, or AI, big data is another theme. So I've got about, I don't know, perhaps, and gold mining is a theme. Solar energy is a theme. So I have perhaps 20 themes. So to answer your question, I've got country, sector, and themes.
Amazing. So you've got a whole lot of data. So when you look at that from your own, I know obviously you're producing it for clients, but do you use it for your own investment purposes?
Absolutely, yes. It's a lot of it is motivated, self-motivated to understand what works, and the feedback. It also gives me the feedback. When I lose money, then I obviously made something wrong, and that's an honest feedback. Whereas if someone compliments you on something that might be, it's also valuable and it's nice, but having also a P&L being invested is a very direct feedback.
So how does it practically help you? So for example, if you've got a lot of 9s in the market and you're seeing very strong momentum, is that something that you would have, because obviously you've been running this for a while, would you have seen the change that then got you into that trade? And then when you see the 9s going down to 8, 7s, and then maybe quickly to 1s, you exit?
One very big distinction since 2022 is this energy regime and tech. The other one I call tech regime, and because I think in risk management correlations are very important, and there is, I sometimes use the term felt correlation. Sometimes it sort of like feels that the correlation between energy and tech is -1. So it's either one going up and the other down, or vice versa. I think that is reasonably consistent. In 22, energy was going up, and the tech stocks were going down. And then 23, 4, and 5, it was the other way around. And now I think we're in a situation again where the felt correlation is still minus one. So I stick with that idea that we know if we measure correlation mathematically, we understand that correlations are very volatile. That's why I use the term felt correlation. It's sort of like I assume that we are now in a regime where energy outperforms IT, and I invest accordingly. And I do not predict how long this will take. So I cannot say the last year, like in the reason why we know it in 2022, because it's the past, right? But in 2022, you didn't know, let's say in mid-year, you didn't know that energy would continue to rise and IT would continue to fall. So I don't make a prediction, but I go with the trend.
I was going to say your description of your system sounded very technical. I'm a technical analyst, technical trader, so the way I look at markets is I have ideas, but it's generally driven by that. And your analysis of the Novo Nordisk chart is a perfect example of technical analysis. You've got a trend going up, the rate of trend up. You've got a topping pattern. And then you've got the rate of the trend going down, which is almost textbook, pretty much textbook. But you also have a very similar attitude to, I think, the correct attitude to technical analysis, which is that we assume that you never know what's coming next, and you just let the market conditions tell you what's coming next, and then try to follow it rather than predict it. Although we also try to have some form of prediction, but knowing that it's completely flawed and the market may never follow that. Do you have any technical analysis background, or have you just implemented it as a secondary part of your analysis?
Well, my background in technical analysis goes back to 1988 when I was a trainee. I had to my first job on the trading floor was to print out charts for a trader, and then he draw some lines on those charts. But for me it's not a negative. I'm not an academic. I'm not an intellectual, and I think in sort of like in hardcore finance, technical analysis is perceived as a bit stupid. I don't think that's true at all. And my view is that the most honest thing we have in finance is the price, even if the price can be corrupted. I think it's Jim Rogers put it nicely. He said the price is where supply and demand hang out, right?
Yeah.
So that the price information, I think, is extremely important, and the changes which have such an important aspect is an important aspect of my work is just the first derivative of this supply and demand. And I was also influenced by the sort of like the hedge fund industry. I feel they have that philosophy that like the managed futures, sort of like CTAs, commodity traders in the 60s and 70s, where they just follow trends. And I think I try to blend. And that's why my score is 4 points for, you could say my score is 4 points for technical analysis and 5 points for fundamental analysis. So it's a mix between these two philosophies or approaches.
Tim, I'll keep going unless you've got something.
No, keep. I've got nothing to add to this. I mean, it's interesting to hear. So
okay.
Go for it, Paul.
Well, I was going to say, it reminds me. Obviously, the price is the most important thing, and criticisms of technical analysis. I've basically heard them all, and it's like criticisms and practical applications are two very, very different things. There are people who apply technicals really badly. There are people who probably apply value investing really badly. And that doesn't mean that the actual discipline is at fault. It just means that it's not being used correctly. There's some terrible chartists, there's some great ones. It's really what works for you as well. And some people fall into technicals because they think, oh, I don't want to learn about the markets, it seems easy. And that's a big mistake, because there's nothing that's easy in the market. But what is for sure is everyone has their own method that kind of makes sense to them. But undeniably, among all of that is the price, as you say. Interesting that Jim Rogers says that, because he doesn't like chartists. He's very negative on them. Yet he worked for a fund with George Soros, with Stanley Druckenmiller, who is a chartist, who made one of the best market calls in history, shorting the pound. That was Stanley Druckenmiller, who is a technical analyst and very, very, very successful. And people like Paul Tudor Jones. So it's such an interesting area. But again, it's like, I don't think trying to convince anybody to do anything that's outside of what they find works for them. But the book Reminiscences of a Stock Operator, I think, is one that highlights for me the most important element of price, and why, if you put all the news aside, which again, Tim wrote a fantastic piece about this recently, about how I think what I find interesting about all of this is we all sort of come to the same common ground on certain issues, but then look at things in a different way, given our own tastes in how to operate within the market. But the Reminiscences of a Stock Operator book, which is, I would highly recommend to anybody, it also happens to be a book that Tim's written the foreword for, which I think is amazing, because this is possibly one of the greatest books, if not the greatest book in financial history. I'm assuming you've read it.
Yes, I have.
Yeah, and for me, that kind of nails the whole point of what price is all about. But when it comes to your actual, your measurements of these different metrics, could you share some of them with us at the moment? Because we've got a lot of listeners that are interested in gold and gold miners and also commodities, clearly, in general. Are there any outstanding metrics that you think are worthy of sharing at this point?
Yeah. So, for example, I've got 4 types of scores. Like, I've also got a macro score, and they are quite high. So, for example, the world is a 9, and because all the variables behind that give a point. So the 9 is a maximum. But I need to open a file quickly. So if I go now on the themes page, I have a ranking where fossil energy is at the top, and U.S. cannabis is at the bottom of that ranking. But now cannabis is sometimes sort of like it's cannabis is the theme is actually the legalization of cannabis in the U.S. It went up. It follows sort of like a boom and bust cycle, and it's not something I invest in. Let's put it like that. But it's still a theme. But it's at the moment the cannabis theme has a score of 1, whereas fossil energy is actually only a 5, and the reason is that it was long in 2025. It was long a 1 or a 0 because the price went down and earnings were revised downwards. But now what happened is that it's starting to get points for price, right? So that's the price is quicker than the analysts with their earnings, and that brings me back to the change of change. So the score is one thing, right? But then the change of change is very good in energy. So it's like a reassessment of the entire sector, and the market is smart enough to anticipate or to nowcast that in real time. Obviously, there was a disruption with this new war. And now, for example, the second best theme is rare earth mining. That has been a theme which has been going on for quite a while. So the gold theme is the oldest in metals. It's about 5 years old. I measure gold relative to 17 different countries, and against the weakest currency, which is the yen, from those 17, I got the signal about, I don't know, 5 years ago or something, and then it changed positive relative to other currencies as well. Then it took a while for the miners to pick up. But if I look at, let's say, gold mining was very long a 9, and now it is, well, actually, as of last Friday, it's still a 9 actually on my ranking. But it's sort of like mid. It's in the middle of the ranking. Number 3 is space. There the score is still a 9. Then the number 4 is clean energy. So that's also, clean energy is also like a bit of a boom bust cycle. I mean, especially solar. It's either, so there's an ETF called TAN, TAN, and it looks a bit like Novo Nordisk, right? It either catches the imagination of the investors, or the opposite is the case. But clean energy is only a 4, although number 5 is solar, which is a 9, right? Nuclear energy is I think number 7. Smart grid is also on there. The metals and mining is a 9 on my score. Defense is a 9 on my score. Silver mining is also a 9 on my score, although that had a bit of a setback recently. But if you look at the extreme rise of silver miners, then that puts it in relation. And then lithium is also a bit of a boom bust metal. It went up a lot, and then I think it had 2 years where it went down in a straight line, and then it turned, and now it's lithium and battery is a theme, which is also a 9, and so on.
Interesting. I mean, you mentioned silver miners, and it's clearly reasonable that they have a bit of a pullback given the massive acceleration. But it's interesting that it's still showing a 9 even on the momentum, because clearly it's come off a bit.
Yeah, it has. Yeah.
Yeah.
But I have for example, Fresnillo my medium term momentum was positive for 61 weeks, and it turned negative last Friday.
Right, so that's good timing.
That's a bit of a drawback of if you're focusing on. I mean, the founder of JP Morgan said he never buys at the bottom, never sells at the top. So he's in for the middle 60%. And if you look at with my method, that's actually quite wise, because I don't pick bottoms and I don't sell at the top. Right? It's my method. My method. Yeah, my methodology just doesn't do that.
That's so technical. That's exactly what technical analysis attempts to do. You're not trying to. You will get caught out if you're buying into a trend at some point, but the idea is that trends tend to exist for sustainable periods of time, and then you see the sign. I mean, look, if you look at the chart of Fresnillo, classic double top. For those of you that look at charts, it's very, very clear, and that breakthrough, £33.35, it's very, very clear. And so it's interesting that your system gave a sell. Well, I'm saying it's a sell. It's not really a sell. It's just saying that the momentum's come off last Friday, because it actually was. It's just broken down the last 2 days, and that would be where the technical sell signal would come in. But it's already. But from your method, it was coming off possibly because the momentum was just going sideways.
Yeah. It was positive before that for 61 weeks, which is quite unusual. So I also measured these frequency distribution of my various measures, and they're sort of like medium term momentum. We're talking about the median is about 8 weeks. So 61 weeks is extraordinary. So some of these themes are really, really abnormally long. Essentially, since the Trump, and actually before the Trump trend, so since 2025. I mean, 61 weeks is more than a year.
So if you're at a dinner party and somebody says to you, so what should I invest in? I guess that you're going to get quite a long answer. Would that be fair?
Well, I think my answer would be consistent with the top ranking themes. So I'm going, actually, I would at a dinner party, I would go with the narrative of the energy regime, and I think my answer wouldn't exceed 2 or 3 minutes. So I wouldn't bore my guests or the other guests with a narrative of 20 minutes.
Oh no, I didn't mean that you would do that at all. I just meant that they would.
Paul's used to speaking to a blank wall, by the way, so it's not a problem for.
I just meant that there would be so much data and information that you could impart that would be fascinating. I find it absolutely fascinating, but that's just me. I'm actually just curious as to what you mentioned, cannabis being on a low number, and then just I had a quick look at the chart and it looks like it's kind of basing, maybe getting ready to move up. But you said I wouldn't buy that. Why would you? I mean, clearly you'll measure it because somebody else might be interested in it, but why would you gatekeep certain sectors and say, right, I just wouldn't buy that? Because for all we know, cannabis could be the big performer in the next 5 years.
Yes, but then it would be on my radar. If it goes from 1 to 2 or from it would go on my radar. And it was, I had the ETF once when it scored, but it's not on my main radar at the moment at all. I mean, I just noticed while I was talking to you, there's even 2 themes which have a lower score, a score of 0, which is fintech and blockchain.
Oh, right? Wow!
Those are 2 themes, and I think fintech has been quite a while since that turned negative because for me, that's why I also look at banks separately. There's always this. There's this idea that in an equity bull market, banks need to do well. And from a risk management perspective, there's this idea out there that there's something wrong in private equity and private credit. So you need to pay attention to the proxies of that theme, right? Sort of like the Blackstones of this world, and fintech and banks. They're certainly on my radar, and they were very green. I use red and green in my research. They were very, very highly scored in 2025, but that has changed. That is actually one of the big changes this year, and it's a negative, right? It's a negative aspect. So I think one needs to be careful in the financial sector. But the earnings in banks and the earnings in financials, there's hardly any negative data points there. So it's really just the price which is changing first.
What you're saying is intuitively sounds correct to me, because what I'm seeing is there's, with the banks, definitely there's the trends were just very fierce and strong to the upside, but now they're starting to top out. There's definitely something going on there that whether it's a big correction now or whether it's part of i.e. whether it goes straight down now or whether it goes sideways for a while and sort of churns before it goes down. I think it's showing that your system is picking up on anomalies that do need to be, addressed or at least considered, which I think is really interesting. Do you actually look at currencies as well and bonds within this? I know you can't really value them that way, but do you have a different type of metric that could be used for bonds and currency separately?
Yes, I do actually. But there it's in bonds as well as in FX. It's mainly price.
Right. So it's pure technical. Yeah.
Yes, it's. I would say it's pure technical, and I also consider the standard deviation in FX. So I want to know if everything is going down against the dollar, a currency which is going down fast will have a lower score. So, for example, the yen is a 1 on my score, and the Turkish lira is also a 1 on my score. And the currency of India is also a 1 on my score, and the currency of the Philippines at the moment is a 1 on my score. The Swiss franc, for example, is only a 5, although as a Swiss, intuitively, we think of our currency, the Swiss franc, as the strongest. But and typically it is. It typically has a high score. It's never like a 1 or a 2 or a 3 on my score. But at the moment, it's
yeah. That's fascinating. But so if the Swiss franc is a 5, what is a 9?
Well, in FX, I also include gold in that, and it could be gold was a 9 like for ages, and now it's an 8 as of Friday, because I think 1 month return is negative, so that's one factor. But none of the so like the momentum measures has changed, and the Bitcoin was long a 0 and Ether as well, and now Bitcoin is a 3, because so like the short-term changes have turned positive, and that's also I also look at the correlation between gold and Bitcoin, which I find fascinating, because there are years where the felt correlation is 1, and now last year the felt correlation was -1, right? And this year so far it's gold is the clear winner on that score.
So where does the dollar sit then? Because I'm just thinking in terms of traditional currencies. Yeah. The Swiss franc still looks the strongest, but we've had a little bounce recently with the dollar. So you might say the dollar's the strongest, but then we've got the commodity currencies like the Aussie and the Canada, which have been clearly doing well because of all the commodity moves. They should be ranking fairly high, but I'm curious as to what your system says is absolutely the number 1 outside of gold.
Well, I've got 3 currencies on a 6. That's Australia, the US, and China. Those are hold on. I've got a 7. The currency in Malaysia.
Oh, really? Right.
Yeah, that's a 7. It's I measure these things against the US dollar. So what happened? Now with the recent the past 4 weeks or so, where the dollar was strong, it moved up in the rankings, and that's sort of like the change of the score again, which matters. So it's from a practical relevance point of view, it's actually not the score itself that is important, but the change of the score, the change of the change, right?
Yes, the delta. Yeah.
Score is based on the change, but when something is moving, then that's really much more interesting than the score itself. And The US dollar was spent a lot of time in the worst quartile in my ranking, right? And then it started to move up, and that's when you need to start thinking about the dollar, right? If like the Japanese yen that has been in the worst quartile for as long as I can think of, which means if you have exposure, you just need to hedge that the currency. End of story. But when the score might start to change one day, that's when you need to rethink your attitude towards a currency.
Interesting. And with bonds, we can see that, for example, the UK, well, most of the G7, but not necessarily the US. The US yields have actually held fairly steady, whereas we're seeing some quite aggressive moves further out the curve in some of the other markets. I mean, if we look at Australia, for example, 10-year yields are about to break 5%, and 3-year yields have been moving up very aggressively as well. There's something definitely going on in short-term yields, and it just doesn't seem to have hit the US yet. But there's something happening there. Are your models picking that up too?
Yeah. Now my bond score for the US, which is typically based off 10 years, so it's 10-year bond indices that I look at, and it's a 5, right? But these bond scores they have fallen quite recently. So in 2025 was actually quite nice for this 60-40 portfolio, right? Where you have equities going up and the correlation between equities and bonds being positive. But now what could happen is that in a bad year, the correlation stays positive, but both go down, right? So the bond scores are definitely falling. And for example, a 1 score I've got in Brazil, in South Korea, Thailand, and also Japan. Yeah, those have bond scores which are worse than the 5 that is the US.
Right. No, that's interesting. And where's the Australian bond? Have you got the Aussie bond? What?
There it's a 6, so it's better than it has a higher score than the US bonds.
Yeah.
At the moment, but that's also based off. That's based off entirely of price. So yield curves are in my macro are a factor of my macro model, not the bond model.
Brilliant. So I'm just trying to think. I don't think there's anything else that I can. Any other questions, Tim? Was there anything that occurred to you whilst we were talking about these last few things?
No, that seemed quite exhaustive. So I'm nothing from me.
Yeah, I got quite geeky there, Tim. So
it's fine. You're allowed to get your geek on, Paul. It's what you're here for. It's a geekapalooza, not just a macropalooza, a geekapalooza.
Absolutely.
I'll email you after this call. I'll email you some documents so you see what I was referring to while I was talking.
Brilliant. Yeah, thank you.
Yeah, I've got a website, so there's some samples are on there.
Brilliant.
And also Substack will give you a flavor of it.
Yeah, fantastic. Well, thank you. So, Alexander, was there anything that we should have asked you that you wanted to talk about?
No, I didn't have an agenda, so I was quite open to what you come up with.
Brilliant. Yeah. Well, in which case, we'll go to media picks. And Tim, what have you got for us this week?
So I've got an old favourite of mine, and I'd be interested whether Alexander's familiar with it. It's a book called Groupthink by Irving L. Janis. And it's basically a study of, well, the subtitle is Psychological Studies of Policy Decisions and Fiascos. And you might think, why on earth would I be citing that after the US and Israel have just started a catastrophic war in the Middle East? But so this is from I don't know which edition, maybe the 83 edition. Groupthink played a major role in the fiascos of Pearl Harbor, Vietnam, Watergate, and could be operating in your own organization. So it's basically a study of how groupthink works, particularly in a political context, and also how certain politicians, notably JFK, actually managed to benefit from previous examples of groupthink disasters and turn things around. So groupthink's basically the dynamic whereby once you get decisions made by a committee, it invariably it comes to the wrong conclusion. And one of the reasons I cite it, because I'm citing it in a commentary at the moment, is that you wonder whether a certain President Trump is aware of the dangers of groupthink. And the way JFK managed to partly reconcile, obviously he was unfortunately assassinated soon after he'd learned this lesson, but the way he adapted to it in cabinet was he would start a cabinet meeting by laying out the problem or the challenge or the issue at hand, but would then let everybody else speak before he weighed in at the end, as opposed to saying, here's the problem, here's what I think. And when the president says something, everyone else is going to weigh in line with the president anyway. So it's a fascinating study of basically a selection of policy horrors from the US during the course of the 20th century. And I think it has an amazing relevance to the world we're in now. It's called Groupthink, and it's by the author Irving L. Janis.
And when was that published?
Well, there's a paperback that goes back to 83, so I'm thinking it's basically 70s, 80s originally.
Right.
But it's kind of timeless.
Oh, absolutely. It was, an updated version of that would be interesting as well. There'd be plenty more.
I think Trump's inadvertently provided us with the next chapter.
Yes, absolutely.
Well, one book I enjoyed a lot on risk is called Risk Savvy. It's by Gerd Gigerenzer. That's a German professor, and it's not finance related, but a big topic is the error culture, that you learn from errors, and it makes a great comparison between the attitude of risk in the airline industry versus hospitals. And that I think would be my sort of like best pick to that section.
Risk itself and measuring risk, the Sharpe ratio versus the Sortino risk measure. Mm-hmm. Do you think the Sharpe ratio is reasonable? Well,
I think I also enjoyed nearly all books of Nassim Taleb, right? And for the past 25 years, or starting in the year 2000 or 2001 with Fooled by Randomness is a great book.
Yeah.
I'm sort of like on his side when it comes to return distributions. And what that means is that all these ratios, they're not that valuable because it's sort of like these academics, they spend their time and their careers in a model world, whereas investors spend their time and lives in the real world, right? So that's why, in the 1990s, I might have said things like, "Oh, the Sortino ratio is better than the Sharpe ratio for this and that reason." But I don't look at these things anymore. So, I think you need to spend time accepting that these return distributions can be really weird, and all these financial textbook measures, they do not address that properly. At least for my use as an investor, I don't care about Sharpe ratios anymore.
That's interesting because it's actually knowing that it's imperfect, which is kind of important at the same time, rather than thinking that it does actually provide. Or expecting it to give you information beyond its real world application, which I think
that the work actually goes back to Frank Knight, who wrote in the 1930s. So he actually predates Harry Markowitz with portfolio selection, but it is the Harry Markowitz which entered the financial industry, and then 50 years later or 60 years later, Nassim Taleb comes along, and his work is a lot of it might not be new, but it's just it was unorthodox, right? But today, I think a financial professional should be familiar with his work, right?
Yeah.
Definitely. So you could argue I'm a CFA, which is a wonderful thing to do. I did that in the 1990s, And that's the model world, right? And Nassim Taleb, he's in the real world where these distributions, they're a lot less elegant than in the financial textbooks.
So the quote I'd bring to bear here is that no battle plan survives contact with the enemy.
Exactly, yeah.
Tim is the quote master. I'm guessing you guys could go back and forth with your in a quote battle.
We could have a tennis match of the mother of all quote tennis matches.
I would need my notes though.
Well, if you're ever coming to London, let us know, and we'll have lunch.
We'll rent a court.
Yeah,
okay.
Let battle commence.
Okay.
Brilliant. Well, Alexander, thank you once again for coming on the pod. It's been a real pleasure. So for people who want to learn more about your research, where would we head them to? Well,
my website is called Ineichen-rm.com. So Ineichen-rm.com. And then I also have a newsletter. I think it's called Alexander Ineichen newsletter or something on Substack.
Right. Okay. So we'll include links to that. Just for somebody who might be out and about, could you just spell out your surname for them for that link?
Yeah, it's Ineichen.
Brilliant. That's absolutely fantastic. Are you on the socials at all? Do you do X or LinkedIn?
Yes, I'm on LinkedIn, but I can't say I'm active. But myself can be found on LinkedIn.
Thank you so much.
Thanks, Alexander.
Okay, thanks. Bye-bye.
Bye.
Bye.
Thanks, everybody. This podcast is for entertainment purposes only. Please do your own research or contact a professional advisor.